Hello, and welcome to the Transform Masterclass series by Dr. Karina Felix. Every week, I put out information that will help you on your personal, business, and spiritual journey. And once a month, on the last Wednesday of each month, I get to invite one of my guest artists helping people achieve their financial freedom, their personal awareness, their spiritual growth. And so today I'm so excited because I have Miss Barbara Sardi, who I've known for a very short time, but she showed up at the right time because she had a message that I've been seeking for a long time. And it's all about finance and it's all about freedom. And I am so excited to share this because we have been talking about this for a while. And I am sure you are going to get extremely great information out of that. But first, let me share with you who Barbara Sardi is.
Barbara Sardi is a wealth protection specialist who has carved a niche in financial services and real estate by leveraging innovative strategies to build generational wealth and achieve financial independence for her clients. Since 2018, Barbara has been empowering clients to transform their financial futures through proven techniques like the infinite banking concept. Her expertise spans insurance, real estate investing, and financial planning, making her a trusted leader in her field. One of Barbara's career highlights includes using her own infinite banking strategy to purchase and renovate a short-term rental property. This endeavor added significant equity and cash flow to her portfolio, showcasing the practical application of her financial expertise. Beyond her professional achievements, Barbara is passionate about living a life of abundance and health. Her love for luxury travel, culinary exploration, and wellness underscores her belief that financial independence is the foundation for a rich and fulfilling life. Barbara's dedication to lifelong learning and self-improvement reflects the same principles she brings to her clients, helping them secure their futures while enjoying the journey along the way. Barbara Sardi has helped hundreds of clients protect millions in assets and achieve the peace of mind that comes with securing their legacy. Her commitment to building generational wealth and financial independence makes her an invaluable partner for anyone seeking to create a prosperous future.
And here we have Miss Barbara Sardi.
All right, everyone, it's great to have you here today and talk about something that I'm very passionate about and teach you guys a little bit about how to create generational wealth using a financial tool. I'm going to share my screen here. Basically, what we're going to go into is how to become your own banker. And there is a specific strategy that I've used for this. I started learning about this in 2018. And when I discovered this and I became very passionate about it, I opened up a policy and ended up using this to purchase a real estate investment property. And from there, I just decided this is something that I really want to help others learn about because it allows you to create multiple streams of income and having your money work for you in two places at the same time. So I do have this mission and desire to build generational wealth, not just for my family, but, for my supportive parents and of course for my clients as well. For me, this is, it goes beyond just having money today, but it's how to make sure that it lasts all the generations that come after us, right? And it just allows you to live limitlessly and basically turn your dreams into reality using a very, very powerful financial tool. So that's just a little bit about me and why I do what I do. And this
go back to when you first graduated, either high school or college. What is the best piece of advice that you would give to your younger self?
Buy life insurance, whole life now. A lot of things people don't understand is this America, namely the Rockefellers, started with whole life policies that allowed them to basically put a policy on 15, 20 members of the family, and they put it in a trust that kept their money together, and They borrowed money from the trust to buy cars and buy houses instead of paying it to the banks. And they've done that over and over and over again. And now with the information age, things like that are available. For instance, I put one on my son, who's 19 years of age. He pays $200 a month for a $300,000 death benefit. Along the way, when he's 35, wants to buy a house, they have $50,000 he can pull from that. When he's 50 and his kid starts going to college, he'll have over $100,000 he can borrow from that. Also, when he's 71 years of age, he'll have $1 million cash. He'll have $1 million in death benefit.
Yeah, so that's just, a CEO of an insurance company just talking about the benefits of that, just so you can get an idea a little bit of how that works. But today we're going to go over a couple of things specifically with infinite banking. So we're going to go how to protect your wealth. We're going to dive into that. And then we're going to go into how to grow it using this tool and how to build that generational wealth. Okay. And then there's various ways to go about it and use this policy, because you can also use it to get out of debt. You can use it to finance large purchases for as a college fund. So it just depends on each person's goal and situation. That's customized on a one-on-one type of situation, but I'm going to give you an overview of how that works. So, of course, we want to protect the hard-earned money that we do have coming in. And so this strategy allows you to protect that money that comes in, and it's safer than any bank or the stock market, and you get guaranteed returns. This allows you to grow your money tax-free and utilize it tax-free due to the nature of this type of policy. Another benefit of it is that you're able to have protection from creditors and predators out there who might try to sue you if you have a lot of assets, right? And it's also a hedge against inflation, which we all know that's been happening rampantly in the last few years, and we can feel it in our pockets, right? So this is a way to help keep that balance by having an asset that kind of catches up to that. Okay. So the way that this can be used as a tax-free retirement is due to a tax code. It's the 7702, which this tax code is actually specifically written for whole life insurance policies, because these policies are not taxed as an investment, although they're growing and earning that compound interest forever. The IRS has a specific code in there, and interestingly enough, the wealthy people, they're the ones that. So basically, this is a tax-free retirement option where you also have a benefit with the tax code 7702, which is something that was written into our tax code by wealthy people as a loophole to allow this type of vehicle to not be taxed like an investment, although it does grow and it does have financial benefits like a real estate property or stocks and bonds, right? Except that those are taxed once you do pull the money out. Whereas with this, you can use it tax-free due to this 7702 tax code. So that's one of the big benefits with this, is that it allows you for a tax-free retirement, whereas you would pay 20+% taxes on your retirement. You can build this up and have a tax of, let's say, not a tax, but you would pay an interest of, let's say, 4.5%. So that's a pretty big difference. Now, in terms of the protection from predators, we talked about that a little bit. This is outside of the government and Wall Street's control, and it's protected from creditors and lawsuits, including bankruptcy in most states. Of course, each state has a little bit of varying laws, but it is something that gives you that peace of mind where you know that if you do have a lot of assets, then this will provide you that sort of protection. And we went into the hedge against inflation. Because of the compounding interest that this has, it allows your money to basically snowball and grow in a way that can keep up with inflation versus having your money being sitting in a bank account and just being deteriorated from the inflation. So this gives you that guaranteed growth, that compound interest, and it gives you a flexibility of using that money and liquidity to use it whenever you need. So that's another benefit with this. So this allows you to grow your wealth in two places at the same time as well, because aside from earning uninterrupted compound interest, the strategy allows you to grow your money in two places at once. And let's say that you want to buy a real estate property, you're able to borrow against the policy and at the same time have the money still growing in there as if you never touched it, because you're using the insurance company's money and have your money growing in your investment, right? So you've got both of those. And we've got the company also does reinvest the dividends, so you're able to get additional dividends aside from that guaranteed interest. So some of the advantages of using the strategy is that it is highly liquid. So you have simple and easy process to access your money. There's no hoops to jump, credit checks, nothing like that, like you would with, let's say, refinancing your house or getting a HELOC. You do have to do a lot of things and have credit checks and certain things in place. With this, your money is fully liquid, which is great. This gives you low risk and high control. And usually we want to keep the low risk investments at a higher amount. This isn't considered an investment. This is more for banking purposes, but it allows you to hold your money in a place where that risk is low and still growing and compounding while you're investing in other things, which you can use that same money in there to do so. And aside from all of that, this allows you to build a legacy, because when you pass it down tax-free. It's not subject to estate taxes and probate court and all of that. So it avoids a lot of headaches for your family down the line, which of course you want to always take care of your loved ones. And everything you've worked hard for, you want to make sure that they have access to, right? So one of the things that I always look at, this is a hierarchy of wealth, is we've got tier 1 through 4 assets. This type of policy is considered a tier 1, meaning that you have the least amount of risk because you have that guaranteed interest. And basically we want to build from there. So I always look at this as a foundational tool. This isn't an investment strategy, right? It's not an investment at all. It's life insurance and it's used for banking purposes, but this is something to build on. So people always ask, well, isn't it better if I just invest my money into the stock market or real estate directly? Well, this is kind of a protection, because if you do lose in high risk investments, this can give you a protection, because let's say that you borrow against this to invest in real estate, you lose your real estate, but you never lose that initial money you put in the beginning, right? So you've got that protection here. It gives you that control, and then from there you build on that. And so I always look at it as a foundational building piece, not a investment or you know, an if or and it's more so like this can help you build, right? So that's always good to look at. So then in terms of building that generational wealth, right, this ensures that your heirs receive this tax-free once you do pass away. But the whole point of it is, of course, that you're building up your investments with this while you're alive and then able to pass that down generationally as well as the death benefit from here, right? So this allows you to create that legacy and accumulate and then transfer. And it's something that you can use for educational purposes for your family as well, because when you learn about this, you can teach it to your heirs and show them how to become financially independent by using this type of tool, and how to take control of their finances versus allowing, the system to basically dictate and take that control, right? So some real world examples of this type of policy being used to create amazing things in this world. I'm sure you guys have heard of this gentleman, Walt Disney. Well, little fact about him is that he actually used his infinite banking policy, a life insurance policy with the cash value, to fund his dream, because the banks wouldn't look at him. Nobody would lend him the money to do what he wanted to do, which was to create this magical world of Walt Disney. And this allowed him to have the control he needed over his projects. He didn't need external investors, and he was able to leverage this tool, this financial tool, to achieve his personal and business goals, which is something that he really made a difference in the world, right? With having that. So sometimes if someone doesn't believe in our dreams, but we have something like this, then we can invest in ourselves, right? Another big one is Ray Kroc. He had a policy as well, and of course he worked really hard to get where he needed to get to, but he did use insurance money to be able to help him continue to grow the business and keep moving forward, because of course he faced a lot of challenges. I know he didn't take a personal salary for like 8 years, but he kept going and going, and he ended up using what he had as in his cash value to keep himself, to fund his business, right? So this is a great way to fund those businesses, investments that you feel passionate about and want to keep moving forward. So these are just a couple of examples of companies who use this strategy. And another one,
the Rockefellers were the wealthiest family in
the Rockefellers, and this will just give you like a little bit of a recap of them. And it's interesting because the Rockefellers, they were kind of in the same boat as the Vanderbilts. The Vanderbilts actually were wealthier, but they didn't have a strategy to allow them to continue that wealth generationally. And by the 4th or 5th generation, the Vanderbilts completely disappeared, and the Rockefellers grew more powerful and wealthier, and just are well known today, obviously. And that's because they used the life insurance policies as a way to fund all of their families' businesses, investments, purchases, and everything that they wanted to do. So this is just a little video to kind of explain a little bit about that.
the world, and used a secret system called the waterfall method to continue growing their wealth for 7 generations. I'm going to expose what the waterfall method is. John D. Rockefeller founded Standard Oil in 1870 and took control of the entire oil industry, becoming insanely wealthy. But that's not even why he's considered the savviest man to walk the planet. During this time, there were many other wealthy families, such as the Vanderbilts, who were actually wealthier than the Rockefellers, but sadly lost their money 4 generations down. John D. Rockefeller knew this could be a problem for his family after he passed away, so he created the famous Rockefeller waterfall method to ensure his family never went broke. Here's how the waterfall method works. Every single individual in the Rockefeller family received a very large life insurance policy. The beneficiaries of those life insurance policies always tied back to the trust, and inside the trust was a cash value life insurance policy, which was used as the family bank. Family members could take loans equivalent to the amount inside the cash value, and when they died, their death benefits would pay back any outstanding loans, thus reloading all the funds they used throughout their life. This is the waterfall method, also commonly known as infinite.
Yeah, infinite banking. So it didn't finish there, but basically it gives you an idea of how they used it to continue to build their wealth and pass it down generationally, which is very interesting. And a little bit, in terms of my personal journey with it, like I mentioned, we opened up a policy in 2018, max funded it. It's customized to each person's specific situation and goals. So it's going to vary, right? But the way we structured it was we did $30,000 for the first 3 years and then $10,000 a year after that. And this allowed us to purchase this investment property, which it was 4 units basically, and for Airbnb. And we took money from our policy to remodel this whole thing. And you can see we gutted the inside of this unit here from everything, right? And then we added a 5th unit as well. And then this was after, right? We ended up having it on Airbnb and basically fully furnished, right? So we have the benefit of our money, even though we use the money to purchase the property, remodel the property, we still have our money in the policy earning us compound interest as if we never touched the money. So it's really cool because now we have our property earning cash flow plus building equity, and our policy earning equity as well. Because in a sense, that's what it is. It's earning equity, you could say, comparable to a mortgage. So we added this 5th unit here, which of course increased the value of the property and cash flow, right? So it's just an example of how this can be used. But like I mentioned earlier, you can use this to get out of debt, to finance cars, to finance business equipment, and a host of other things. So there's a couple of books that I like to recommend to start and kind of get you in terms of get your mindset to wrap around the concept. One of them is What Would the Rockefellers Do? And basically how the wealthy stay wealthy, and how we can also do the same thing using the same strategies that they use. This is a short read, but it's a very good one. Explains quite a bit in terms of the process and how it works and how the Rockefellers did it. And then the other book is Becoming Your Own Banker with Nelson Nash. This one is a foundational book on this to really learn the concept inside out. I know Karina has the book and she devoured it immediately once she got her hands on it and learned about it, because she's a avid learner. And so I recommend these 2 books to start with. And then of course, if you want to get a consultation and learn how you can implement this strategy for yourself and kind of get some illustrations drawn up based on your specific situation, whether it's to get out of debt, to pay off your house in less than 9 years, or to build a business or fund any investments, I can help you with all of those things. And I appreciate you guys attending today. I'll leave my contact information here. And Karina, I think we'll give that out. I also have a PDF to give to you guys, so she'll be sending that out as well. And that's pretty much it in terms of the infinite banking concept. And just to give you a little bit of a taste of what it is and how it can work for you and your life.
Well, that was impressive. It was also a lot of information. And I'm
Mhm.
sure our guests may have a lot of questions. So, does anyone have something they would like to ask Barbara here? I mean, my first question to you, Barbara, is you mentioned the two places at once, but there's really at least three different ways of making money on this one policy. So once you
Mhm.
buy this policy, so whatever money you put into the policy, what you said, you want to put as much money in the cash value. So if
Mhm.
you have 100,000 sitting there, it doesn't matter, 50,000, whatever, 100 is easy math wise for me.
Mhm.
If you have 100 sitting there, um, and I take a loan out, I take, 30,000 out as a loan, not just using, but as a loan against, like I would go to the
Correct.
bank
Yeah.
and, I can go to the bank, take this, if I go to the bank, and here's something that's very interesting that most of us don't even think about. A bank
Mhm.
is owned by people, and they
Mhm.
are the shareholders of the bank. And every year they make a profit. So they make, they get dividends and
Mhm.
they make money off of that dividend. But as your own
Yes.
banker, not only are you making interest on your money, you get a dividend as well because you are now a
Correct.
shareholder of the policy company.
Mhm.
You
Mhm.
make money with interest, you make money with the dividends, and then if you actually pull the money out and use it to invest on something,
Mhm.
and of
Mhm.
course, this is what I've told everyone though, you have to be extremely disciplined. This is not the money
Exactly.
you use for vacation and shopping. This is the money you use for investment because you want to put the money back. If you invest it in
Exactly.
a business, the business make money, you put it back. Now, my
Exactly. Or
question,
getting out of debt,
or
right?
getting out of debt,
Because
right?
you're going to pay a lot less interest here than you would with any other debt.
Okay, so once I open the policy, I know the policy, once that's open, that's locked in. I can't touch that. But the cash value, can I put more money and grow my cash value?
Yes, there's a certain depending on how much space we leave, it's customized to each person, so we can leave space in there so that it's not considered a investment by the IRS. So there's what's called a modified endowed contract. So we want to make sure that we keep those balances correct for the IRS purposes. And depending on how we structure the policy, there can be space in there to add more to the cash value.
Okay.
So it just depends. And this is why I go into one-on-ones with people and really have to go in detail with their financials to be able to tell them what's going to be the best thing for them based on where they're going, what, their specific situation is, and so on and so forth.
So my idea is this, if my original is that 100,000 and
Mm-hmm.
I take that 30 out and I, buy a house. Now the house is giving me a income. So, more a rental. It's giving
Mm-hmm.
me income. So I'm putting the money back, right? Eventually I will cover that 30,000, but I still have money coming in. So would that mean that my 100,000 will increase?
Of course, yeah. I mean, and it's always increasing because you're earning a compound interest on there regardless. And of course, because you're putting it back, that's going to increase because you're earning more money on, it's like if you're adding an additional amount in there. So,
Guys know
generally,
she was right. I did get the book and I did devour it, and it is
yeah.
very informative. And you can go to my website. I have it there also as a link. And but yes, so go ahead and continue explaining that this increases. You're not stuck with that 100 or whatever that initial investment. You can increase it.
Yeah, you can increase it, it depending on how it's structured, but then of course, like if you're paying back your loans and you're, replenishing that, that's going to increase it as well through that method. But if you just want to put towards the cash value, it's going to depend on how it's structured. So we can structure it in different ways to do that. And in terms of, so there's different ways to go about it, because like if you buy an investment and you don't want to pay that loan back and you just want to pay the interest using the investment, you can do that as well. Because what happens is that let's say you did put 100,000 in there and then you're putting a certain amount every year. You have, let's say, a death benefit of $1 million. What's going to end up happening, all your outstanding loans will be paid off from when you pass away, will pay off all of your loans. The rest goes to your beneficiaries. So you have that option of not paying back the loan if it's for an investment, right? So it really depends what it's for. Some cases I recommend you do pay it off. Some cases I recommend you don't pay it off. If it's for a car loan, if it's for any other type of, let's say, debt reduction, that I do recommend that you pay that off all the time. But for investments, it's going to depend. So, because you want cash flow, you don't want money just sitting there,
Right.
doing nothing. So,
Make sure.
unless you're gonna, like, if you're gonna pay it off and use it right away, okay. But if you're just gonna have that money sitting there doing nothing, not nothing because it's still growing and compounding, but not giving you the max, that I don't recommend that. So I always recommend keeping your money flowing and moving, because sitting money is
Correct.
kind of like sitting water, right? It starts to, it doesn't do much for you.
And something I want to mention, especially for people who owns a home or has a mortgage, especially if they have a mortgage, we don't realize what a mortgage really is. It is, you end up paying, you might say my house is worth 300,000, but in 30 years, you pay that house 3, 4, 5 times over because of all the interest.
Mhm.
The way the bank set it up is you pay the interest first. They get their money first
Exactly.
before
Yep.
they even go into the principal. So you're paying forever. So I did do some research, and I know we talked about this, is
Mhm.
whatever equity, even if you haven't paid off the mortgage yet, whatever equity you have, you still have a 50% there, or if you own your home outright, now you have a home, it's sitting there. That's money
Mhm.
sitting at the table. So
Exactly.
take the HELOC out, right? Because the only way to get us through a HELOC. And let's say, for example, let's say my house is 300,000. I take a
Mhm.
out so I can take that whole 100% equity out. I put it
Mhm.
in this system,
Policy.
the
Mhm.
policy. I and you say we can take the money out within a week? I can pull it right back out,
Well, so
depending.
when you first open your account, it's up to 30 days, but after that, then it's pretty immediate. Like you just send a document in a couple of days and you've got your money wired to you.
Okay, so now I can take that money back out, pay
Mhm.
off the HELOC, because again, if I'm paying HELOC, I'm paying their percentage.
Mhm.
They're making the money.
Mhm.
Um, so I pay off
So
the
in
HELOC
so
and
in
I'm
that case,
paying myself back.
yeah, in that case, I would have to look at the whole situation and just see, what your interest rate is and everything. But usually the way what I recommend is more so you take that money, invest it in something that's going to make you more money and pay both off with that investment, right? So it could be a property, it could be whatever it is. So that way the investment, you've got your investments really working for you, right? Because you've got your home that's still building equity, because it's regardless, it's building equity. You've got another investment and you've got that policy, and so you're building upon that.
You mentioned in our last interview, Kiyosaki. He said
Robert Kiyosaki.
about using, if he wanted a car, how he would buy property. Explain that part again.
Yeah, so something that he talks about, which I think is very interesting, is basically if you want, let's say, a new car or anything that's not an asset, instead of purchasing the car or the thing, he would purchase an asset that would pay for the car or the thing. And so then that asset will always make him money no matter what. And then he gets his car as well. Does he wait a little longer? Sure. But then he's got an asset paying for his liabilities. And so that's a good strategy, is how can I get my assets to pay for my liabilities, right?
So that's like buying a piece of, using the money to buy a property and then using the income from the property to buy the
Mhm.
car, but the money
Correct.
is still sitting in your cash value. So the next question I have is, how do people, what's required to start a policy like that?
So this is based off of health and age, right? So there is a medical exam that's done because it is life insurance, right? But it has that cash value component. So there is that part, and then of course your age is a factor in terms of how much that insurance is going to cost. Because of course we have to have some insurance, and then the rest goes towards cash value. We do structure it where we do the minimum amount of insurance depending on your situation, because if you say, oh, you know what, I need a certain amount of coverage, then we're going to give you that amount of coverage, right? And we can even attach a term policy on there so that it gives you, let's say you want to make sure that if something happens to you in 20 years, right, we'll attach a 20-year term to that whole life, but it's structured specifically to each person. But it is health and age are factors in terms of the coverage that you qualify for and if you qualify.
When you say coverage, are you talking like how much money I want to leave behind? So do I say, oh, I want to have, 100,000 or a million, or is that how you like? If I said, if I want $1 million payout to my children when I pass away,
Mhm.
how does that affect how much money that needs to go in?
Well, it's going to affect because, of course, because you're going to be paying more towards insurance for that coverage versus towards the cash value. So that's why I am very specific about what are your goals, what are you looking to achieve, and then how we structure it based on that. Because some people do need $1 million in coverage, and so then, of course, then we have to go and structure it in that way, and it'll eat in a little bit into the cash value, or a little more than if you had 100,000 naturally, right? Because you're buying more insurance. So yeah, it all depends on each person.
So in the book also, he also mentioned that there's an opportunity once you've paid in somewhere between 3, 5 or more years, eventually the dividends can continue paying the policy for you long term.
Correct.
A little bit.
Yeah, so after a certain amount of time, depending on how it's structured and how much is in that cash value and how much you're putting towards that, and you're making dividends. I mean, the company we use has paid out dividends every year, so you're pretty much guaranteed dividends every year. And eventually that cash value, when it grows to a certain amount, it offsets the cost of insurance. So
That's good. So even though you feel, what if I don't have a job in the next five years? But by then, hopefully, the dividends and the interest would start paying off the policy, and that would continue. You also
correct.
mentioned that there are moments you don't even have to pay it back off. Um, that's a little hard for us to understand. What do you mean I don't have to pay it off? But that's because if you pass away, whatever is in the insurance will cover the money that you actually used. So I know you gave
Correct.
an example, like you invest in the business and the business goes, go down. Your cash value is still there. You don't have the money to pay it back, but it doesn't matter because eventually the insurance is going to pay it off. Am I correct with that?
Yeah. So, whatever outstanding loans there are, because let's say you were paying off a loan back, but you didn't get to pay it off and you pass away, that will be paid off with the death benefit, which is why the death benefit is your collateral. So that's why the insurance company is going to loan you that money because they your collateral is your death benefit.
Right.
And so if something happens to you, God forbid, before you pay off that loan, or if you decide not to pay off that loan, then they know that they're going to get it from that death benefit.
So their
So
their money
that's
is guaranteed. They're getting their money
their
back no
money
matter
is
what. So,
guaranteed because the only two things guaranteed in life are death and taxes, right?
right.
And they know that.
Well,
So
not in this case because we can get away with the taxes too.
Yeah, well, but we still pay taxes
Understand.
in other areas, right? Like there's always some sort of tax to pay, but this will minimize your tax liability by having this type of policy. So yeah.
Right. All right. So, uh, why don't you explain? Because this is interesting. Is you showed us the video on the Rockefellers, and they call it what a waterfall.
The
But
waterfall method.
and we talked about the discipline. Can you explain why we need discipline and not use the money, like you said, for travel or buying clothes? Like the money has to be used for a certain reason so that it actually, like you said, for asset to make more money. And what happens if people are not disciplined?
They'll get into debt just like any debt they would incur with a credit card, or because you're paying an interest on that loan even though you're earning interest back, right? But eventually there's going to be a deficit, and it's just going to create debt for yourself because you're not making that money work for you. You're not putting it towards paying off debt. Because of course, if you've got debt and credit card debts with 18-20% interest, and then you come in and instead of paying the credit card directly, you put it in here, then pay off your credit cards, and then pay it back to your policy. You're going to be saving a ton on interest, right? So you want to do, that strategy is um, a very common one with this, allowing you to save a lot on interest.
So that
Plus, you're building an asset at the same time.
exactly making extra money,
Mm-hmm.
compounding, and you're making additional, passive income, like you said.
Mm-hmm. Mm-hmm.
So the discipline part is, again, use an example of having 100,000 sitting there. If you
Mm-hmm.
use all of that, you keep using, and not replenishing. Once you hit that 100,000 limit, you're still getting dividend and interest, but you cannot pull money out anymore. Is that how that works?
Correct. Yeah. Well, because the money it's going to run out, right? Like that cash value is going to deplete itself, and you're not going to have any more cash value to pull from.
So
So yeah,
once you pull out that full 100,000, you can reuse the money. You're still making dividends uh,
off of it as if you
off of
were.
it.
Yeah.
You
Hmm.
can use it. There's no more money. You cannot take the money out, and it's sitting there until obviously you pass away and the debt benefit pay off that
Correct.
100,000.
Correct.
But
Yeah.
at least you're not leaving any debt for your family.
Exactly. Hmm.
Okay. So the Rockefellers and their waterfall system, which their infinite banking system, are talking about generational wealth and how
Hmm.
part of the discipline is to understand that the money doesn't actually go to your beneficiaries. It doesn't go to the offsprings. It goes into a trust. Is that
Correct.
how the trust is set? So explain us how to set up the trust to make it generational wealth.
Yeah, so that would be something to speak to a lawyer to, because I'm not a lawyer, right? I'm not a so I recommend that book because it gives you an overview. So when you do speak to your lawyer, you can let them know, look, this is what I'm looking to do. This is what I'm looking to achieve. How do I set up a trust so that I can put all these life insurance policies in here and do this method, right? And so that lawyer, and there's lawyers I'm sure that are familiar with the concept. So that lawyer, and you're gonna have to, look in your area, right, to see who you best have that trust with. But reading that book is gonna allow you to then kind of have the idea of how that trust is to be set up, and then get all the policies in there. That way you can have that generational wealth built up.
So from what I've read and researched is that the way the policy is set up, is that as soon as a child is born in the
Hmm.
family, they start a policy because it's cheaper, because it's a baby.
Of
Or
course.
health is better. So they start a policy immediately.
Hmm.
So I'm assuming the way it's set up is the beneficiary is the trust.
Of course, yeah. The beneficiary is the trust. Everything's run through the trust, but like I said, I can't give
Right.
um
Or
that type of
just so people
advice.
can grasp the concepts
Mm-hmm,
of
mm-hmm.
how it works and why you don't want to waste the money, why you really want to be strategic, very disciplined, always paying it back as if it's a real bank. And you
As Of course,
are
and
your
you
own.
are a real bank, and like you would pay any of your creditors, like you would pay your mortgage and your car, loan and your credit card,
Mhm.
bills, right? You're gonna pay all of that, so you're gonna pay yourself back in that way.
Might
Can
as
you
well.
have a little flexibility? Sure, because you're your bank, but do you want to abuse that power? No. So that's the key here is how do I treat myself with the same respect as I would any other bank, any
Right.
other lender, right?
I think the
So
part I like the best is that it's reusable money. So you take it out, you buy a car, you pay it
100%.
back. You take that same money out, you buy a house, you pay it back. You keep using, or you, because how many cars have you owned in your lifetime? I mean, me alone, I think I've owned, I don't know, six, seven cars so far.
Exactly.
Cars are stuff that we're going to continue buying. Um,
Correct.
Obviously, housing,
Mm,
assets,
yeah.
real
And
estate.
a lot of people will say, "Oh, well, I'm gonna buy cash," but that cash leaves and you never see it back. Whereas if you put it here, purchase the car, pay it off, that money will be growing and earning that
Right,
compound interest. Um, Even
correct.
though, and it's basically like cash, but better because you're earning money versus lose, yeah.
Like I wish I knew this just a few months ago because I just bought a
Hmm.
car. And
Yeah. Yeah,
I didn't even down payment, I paid it cash. And I'm thinking,
exactly.
imagine, because once you pay that cash, it's gone. The
It's
money,
gone. You
my
never
cars and
see
all of
that back.
everything. And I'm
Yeah.
thinking, imagine I had taken a loan out. Like right now, my daughter just bought a car. And
Mm-hmm.
I said, well, let's have a talk with Barbara, start your
Mm-hmm.
policy,
Yep. Because she can
pay
put money in
off
there, pay it.
pay
Correct.
the car whatever loan people and then keep paying yourself off and building out
Exactly. Yeah.
and that's a
Yeah.
security that I'm looking at, especially for us as we're getting closer to retirement age, to know
Correct.
that money is still sitting there.
Mm-hmm.
There's no stock market, there's no inflation, no one can touch it, it's still sitting there,
It's
and then
Yeah,
slowly
you've got that guaranteed interest coming in.
can
Yeah.
live off of that. You can live off of that for a long time and be at
Correct.
ease. It's that ease and peace that I keep looking at. It's so.
Mm-hmm. Mm-hmm. Definitely. Yeah.
Well, Barbara, thank you so much. This was very informational, very, I'm sure there's going to be a lot of questions coming your way. And hopefully, we're going to see much more of you. Barbara is also
Absolutely.
cover feature of the Ophidian magazine December 2024 issue. And her story there also is excellent. You could sign up to get a digital or a print copy. Thank you so much, Barbara.
Yes. Thank you, Karina, for having me. And this was amazing. Definitely enjoyed my time here and sharing with all of you all of this amazing information that I discovered 8 short years ago. And I wish I would have had known about it a long time ago,
Right?
but you
Well,
know,
like I said, our kids will have a different lifestyle if we can teach them.
absolutely. Yeah.
And
Yeah.
again, for those who doesn't know, I have a nonprofit called Visionaries in Motion. It's a 501c3 organization, and we are all about educating the youth on financial literacy because none of this is taught in school. And the sooner
No.
they start, the younger they start, we can totally bring a complete paradigm shift in this
Mm-hmm.
world, bringing
Absolutely.
because everyone says kids are not going to own a home in this lifetime, but with this opportunity, with this system, they
Mm-hmm.
surely can not just own a home, they can own property and build their own
Yeah.
wealth.
They can build a whole real estate empire if they wanted to. Yeah.
So for everyone, Barbara and I have been talking for a while and we're joining forces and we will be offering this on a ongoing basis because I think this is so important and so amazing.
Definitely.
So
Yeah.
again, thank you so much for coming on and I
Thank you.
appreciate you so much and thanks for your hard work and being so clear about it. And like I said, there's going to be a lot of questions. So
Yeah. Awesome. All right, Karina. Thank you so much. Bye.
Bye.
Barbara Sarti, featured on the cover of Ophidian magazine and known as the Infinite Banking Queen, is redefining financial freedom with her expert guidance and revolutionary approach to infinite banking. After mastering the art of becoming your own banker, Barbara has made it her mission to empower others to take control of their financial destiny. Through her proven strategies, she shows individuals how to secure active and passive income, create additional revenue streams, and build a robust financial and asset portfolio. Barbara's approach goes beyond wealth accumulation. She helps her clients establish a generational wealth system that doesn't just stop with their children and grandchildren. It creates a lasting legacy for generations to come. With Barbara's guidance, you'll gain more than just financial security. You'll achieve personal peace of mind, knowing you're building an infinite legacy for your family name. Take the first step toward financial independence and an enduring family legacy. Let Barbara Sarti, the Infinite Banking Queen, show you how to transform your life with the power of infinite banking.